This is the story of how Sydney became officially unaffordable for average Australians, requiring a household income of $305,000 just to buy a median-priced house without falling into mortgage stress. By the end of 2026, only 11% of homes sold in New South Wales will be affordable to median income earners, the lowest affordability rate in the entire country. Over the next 15 minutes, we're breaking down exactly how we got here, what the numbers mean for your future, and why over 100,000 Sydney residents fled the city in just 1 year because they simply couldn't afford to stay. PropTrack price forecasts and predictions from Australia's Big Four banks produced that $305,000 figure through detailed modelling, and it's not some random number pulled from thin air. Sydney's median dwelling value sat at $1.28 million in December 2025. But here's where it gets worse. Median house prices will climb to around $1.7 million by the end of 2026 through a 5 to 7% increase. Buying that $1.7 million house means saving $340,000 just for the deposit, and that's the 20% you need to avoid lenders' mortgage insurance and get favourable loan terms. Save that deposit, and you're looking at borrowing $1.36 million, which is where the salary requirement enters the picture and changes everything for average earners. What lenders call the mortgage stress threshold says you shouldn't spend more than 33.3% of your gross income on housing costs, and this single number separates living comfortably from living paycheck to paycheck. Servicing a loan of $1.36 million without exceeding the 33% threshold requires a minimum gross household income of $305,000, and that requirement currently sits at $291,000 in December 2025. 1 year from now, the income required to afford a median Sydney house jumps by $14,000, and the current median household income in New South Wales sits at approximately $107,000, with the national median around $118,000, $198,000. That's the gap between what the average household earns and what they need to earn, which means you'd need to nearly triple your income just to meet the threshold. None of that accounts for the years it takes to save that $340,000 deposit in the first place. Median income earners in New South Wales can afford just 11% of the homes sold in the state, making this the lowest affordability rate in all of Australia. Households in the 30th income percentile find themselves locked out of 97% of the market, and that's not a typo. 97% of available properties sit beyond their reach. Units might seem like a more realistic path forward, and plenty of people are making that exact calculation right now as houses slip further out of reach. Median unit prices in Sydney hit $950,000 by the end of 2026, requiring a deposit of $190,000 and a household income of $165,000 just to stay within safe limits. $58,000 more than the median household earns. That's what you're short even for a unit. Sydney's median house price now sits $600,000 higher than Melbourne's and around $500,000 higher than Brisbane. And this isn't about paying a small premium for harbour views and good weather. This price gap has grown so massive that it's reshaping where Australians choose to live, work and build their futures, pushing families out of the city they grew up in and changing the demographic makeup of the entire region. 104,231 residents left Sydney during the 2024 financial year, representing 2% of the city's entire population, walking away in just 12 months. Overseas migration brought in 120,886 people and kept overall population growth positive at 79,800. But that number masks what's really happening. Sydney had a net internal migration loss of 41,086 people. More Australians are leaving Sydney than moving there from other parts of the country, making Sydney the only major Australian capital that would shrink without international arrivals propping up the numbers. Queensland drew 30,000 former Sydney-siders who swapped their Sydney mortgages for cheaper coastal living. And these aren't just retirees heading to the Gold Coast. Working families, young professionals, people in their prime earning years have done the math and realised they'll never afford to buy in Sydney, so they're cutting their losses and leaving while they still can. Parramatta South recorded the biggest internal migration drop at 7.6%, while Chippendale lost 6.7%, Rosehill and Harris Park 6.6%, and Camperdown and Darlington 6.4%. Many of these areas were supposed to be growth hubs or high-density zones, but residents settle in initially and then relocate once housing pressures become too much or they need more space for a growing family. 5.5%. That's what the Sydney CBD areas like Millers Point and Haymarket lost. And that tells you this isn't about specific neighbourhoods failing. The entire city has become unworkable for people who don't already own property, and the exodus reflects that harsh reality. Economists call this economic displacement, creating a revolving door effect where Sydney attracts overseas migration to mask its domestic decline, while hemorrhaging the people who've lived here for years, built their lives here, and want to stay but simply can't afford it anymore. Throughout 2025, the Reserve Bank of Australia delivered a modest easing cycle and took the cash rate toward a more neutral level of approximately 3.5%, which had many buyers banking on this continuing into 2026 to make mortgages more affordable. That optimism evaporated as we moved into 2026, with ANZ and Westpac updating their forecasts to indicate the cash rate may stay on hold for the entire year due to what they're calling stubbornly high inflation, 3.4%. That's where inflation sat in November 2025 over the 12-month period, and here's where it gets worse. Commonwealth Bank and NAB have hinted at possible rate hikes in early 2026 if price pressures don't ease, which means we're not talking about rate cuts anymore, but about the possibility of rates going up. Average variable mortgage rates currently hover around 6.5%, and every quarter percentage point increase means monthly repayments on a $600,000 loan rise by approximately $90. Loan sizes for median houses in Sydney frequently exceed $1.2 million, so that impact gets doubled and the pain multiplies fast. 2 additional rate hikes in 2026 would strip approximately $24,000 in borrowing capacity from the average borrower according to CanStar modelling. And think about what that means when you're trying to save for a deposit that keeps getting bigger as house prices rise. Your ability to borrow shrinks because rates might go up, creating a squeeze from both directions that makes the dream feel more impossible every month. 2 to 3% mortgage rates belong to an era that's officially over, with the financial industry now working on the assumption that we're in a higher for longer environment. Buyers can no longer plan their finances around the expectation that rates will drop significantly anytime soon, which fundamentally changes the calculation for anyone trying to enter the market. $544,000. That's what someone on an average single wage can borrow in the current environment, with rates around 6.5%. Rates increase by 0.5% to 7%, and that borrowing capacity drops to $520,000, cutting $24,000 from what the bank will lend you. Drop rates by a full percentage point to 5.5%. And that same person could borrow $599,000, creating a $55,000 swing in borrowing power based purely on interest rate. Monthly payments on a $1 million loan at the current 6.5% rate cost about $6,320. Bump that rate to 7% and you're paying $6,650. Drop it to 5.5 and you're at $5,680. These aren't abstract numbers on a spreadsheet. These are the actual monthly budgets of real families trying to figure out if they can afford to stay in Sydney or if they need to pack up and leave like the 100,000 before them. Prices stay high despite all these challenges, despite the exodus and the elevated interest rate. And the reason is simple and deeply frustrating. We're not building enough homes to meet demand. 179,900 new dwellings got added nationally in 2025, which sounds substantial until you realise our population increased by over 444,000 people in the same period. 60,000 homes annually. That's the gap between supply and demand. And building approvals currently sit at decade lows, with industry experts warning that the National Housing Accord's target of 1.2 million homes by July 2029 sits significantly out of reach at current construction rate. Government infrastructure projects worth $900 billion are competing for the same pool of skilled tradespeople needed for residential housing, driving labour costs to record highs and making it harder to build anything at all. Average detached house approval values climbed to a record 519,000, $906, representing a 6.5% increase over the year. And these rising build costs add pressure to already stretched budgets while making new construction projects less viable for developers and more expensive for end users. But here's the thing. The supply crisis isn't just about construction costs. 80% of Sydney land sits restricted to buildings of 3 stories or less. And within 10 kilometres of the CBD, 21% of land falls under Heritage Conservation Area designation, where you can't build new housing at all. Planning systems often prioritise the concerns of existing residents over the need for new housing according to the Grattan Institute, and the result is that many affluent inner-city suburbs are experiencing stagnating or falling population because new housing simply cannot get built to accommodate younger families. Lack of density doesn't just keep housing expensive, it robs younger Australians of economic opportunity and forces them further away from jobs, transport and schools. We have a housing crisis but can't build up in the areas where people want to live, where the jobs are, where the infrastructure already exists. So people get pushed further and further out. More time commuting, living further from opportunity, all because we've structured our planning systems to preserve the character of neighbourhood rather than house the next generation. October 1st, 2025 brought significant changes to the Home Guarantee Scheme earlier than planned, with the government fast-tracking updates that were originally scheduled for 2026. This expansion represents one of the most aggressive housing interventions in recent history, and the changes are substantial. Income caps of $125,000 for singles and $200,000 for couples have been completely removed. The quota on how many people could access the scheme is now unlimited, and any eligible first home buyer can participate without restrictions. Sydney buyers saw the property price cap raised from $900,000 to $1.5 million, which is the change that really matters for people trying to enter this market. 5% deposit instead of the traditional 20%. That's what you can now use to buy a home without paying lenders' mortgage insurance. So for a $1.5 million property, you need $75,000 instead of $300,000. 3 years compared to 13 years. That's how long the government calculates it takes to save that 5% deposit versus the traditional 20%, representing a massive reduction in the time needed to enter the market and giving hope to people who thought they'd be locked out forever. But here's where things get complicated, and the good intentions might backfire. Allowing higher income earners to access the scheme and raising the price cap so dramatically may inadvertently put upward pressure on prices in the $1 million to $1.5 million bracket. And Treasury modelling suggests the scheme could add 0.5% to home prices over 6 years. Real-world impact in a high-demand market like Sydney could come much faster than that 6-year timeline suggests. You've just made it easier for more people to buy more expensive homes with less money down. And in a market where supply already sits constrained, more buyers competing for the same limited stock pushes prices up. Individual buyers who can now enter with a 5% deposit will find this life-changing, but at a macro level, it risks adding fuel to a fire that's already burning too hot and making affordability worse for everyone in the long run. Getting into the market doesn't mean you're safe, because another trap called mortgage prison is waiting, and it's already caught more than 100,000 Australians who thought they'd made it. Banks can lend only up to 20% of their new mortgage books at a debt-to-income ratio of 6 or more, starting February 2026, according to new limits from the Australian Prudential Regulation Authority, designed to prevent people from taking on dangerously high levels of debt. What hits harder right now is something called the 3% serviceability buffer that forces banks to stress test a borrower's ability to repay a loan at an interest rate 3 percentage points higher than the current offer, 9.5%. That's what banks test your ability to service at when average variable rates hover around 6.5%. And this significantly reduces the maximum amount most households can borrow. Mortgage prison works like this. You bought your home a few years ago when you could afford the serviceability test, but rates have gone up since then. Your property value might have dropped a bit, and now you're stuck paying a higher rate than what's currently available in the market. You want to refinance to get a better deal, but you can't pass the serviceability test at today's rates because your income hasn't kept pace, your expenses have increased, or your property's equity has decreased. Trapped and unable to switch to a cheaper loan, you're living paycheck to paycheck and can't cut back further on everyday expenses because interest rate hikes have already maxed out your budget. 73.6% of all residential mortgages belong to the Big Four banks, and their strict adherence to serviceability buffers means many borrowers stay trapped in higher rate loans because they simply lack the financial wiggle room to switch lenders. Challenger banks like Macquarie have been growing aggressively. Macquarie grew its mortgage book by nearly 24% in the last year, but they're still not big enough to provide real competitive pressure across the entire market and free people from this trap. Renting offers no escape if you can't afford to. Buy, because the rental market provides absolutely no sanctuary from this crisis. 1.6%. That's where national vacancy rates remained in December 2025, creating an incredibly tight market where landlords have all the power and renters have almost none. Rental growth eased slightly in late 2025, with rents up 5.2% annually, which beats the 10% jumps we saw in previous years. But it still sits well above pre-pandemic levels and keeps squeezing household budgets tighter. $780 per week. That's Sydney's median rent now, sitting $40 higher than the national average of $640 and working out to $40,560 annually just for a roof over your head. Remember that median household income of $107,000. Paying $40,000 in rent means you're spending 37.4% of your gross income before you've paid for food, transport, utilities, or anything else. You've already blown past the 30% affordability threshold before buying groceries. And that's the reality for hundreds of thousands of Sydney renters right now. Sydney has the lowest capital city gross rental yields in the country at just 3%, revealing that investors aren't buying Sydney properties for the rental income, but for capital gain. They're betting property prices will keep going up and don't care that the rental return is terrible. And this prioritisation of capital gains over rental yield further squeezes the supply of affordable rental stock and makes the crisis worse. Families are delaying having children because they can't afford a place big enough. Young adults are forced into flat-sharing arrangements well into their 30s, and multi-generational households are becoming normal again out of necessity rather than choice. Only a major shift in supply, coupled with limits on rent hikes and increased funding for social housing, can prevent this crisis from deepening further through 2026, according to advocacy groups. But none of those solutions appear to be coming fast enough. Most people are locked out of the traditional Sydney housing market, but the market keeps moving and people keep buying and selling, just not where you might expect. What experts call a two-speed dynamic characterises the 2026 property market, where different asset classes and geographic regions perform in starkly different ways. Premium suburbs, with multi-million-dollar price tags in the upper quartile, actually dropped slightly by 0.1% in December, while the lower and middle quartiles rose 1.1% in the same period, reflecting a shift in demand, where people who would have bought in premium suburbs get pushed into middle ring locations. 12.5% annual growth hit St Mary's with a median house value around $980,000, while Marylands and Guildford also posted 12.5% growth with median values around $1.15 million. Richmond and Windsor grew 11.6% with median values around $1.05 million. And all of these sit in Greater Western Sydney, benefiting from infrastructure investments, new transport, links, and a desperate search for value by buyers who want to remain within the Sydney orbit. Close enough to commute, but affordable enough to actually buy. That's what Western Sydney offers right now. And the growth numbers reflect that reality. Premium eastern suburbs only grew 3.4%, with median values above $4.5 million, while middle ring Parramatta saw 6.5% growth, with median values around $1.35 million. Property types are shifting too, with Sydney unit prices expected to grow by 23.4% over a 3-year forecast period and significantly outpace the 15.8% growth expected for houses. Industry insiders call this trading backyards for balconies, and family-friendly apartments in lifestyle suburbs are becoming the only attainable option for median-income households who are giving up the quarter-acre block dream, but at least getting into the market. Regional dwelling values rose 9.7% in 2025, compared to 8.2% for combined capital. And people are realising they can have better quality of life, more space, and lower costs if they're willing to leave Sydney entirely and start fresh somewhere. The numbers actually work. 5 to 7% growth for Sydney dwelling prices. That's what experts predict for the rest of 2026 in what they call sustainable motion, rather than explosive growth. Last year's frenzied gains are shifting to a more tempered phase of appreciation, following a pattern of what industry observers call a year of two halves, where the first half builds momentum and the second half hits the brakes. Government stimulus from that expanded home guarantee scheme and lingering effects of the 2025 rate cuts should drive momentum in the first half, but the second half is expected to slow down as Affordability Ceiling act as a handbrake on the market. Prices can only climb so high when wages aren't keeping pace, and eventually you run out of buyers who can afford to pay more, no matter how badly they want to live in Sydney. Further rate hikes represent the biggest risk to this forecast, and while some economists think talk of hikes is premature, the Reserve Bank watches the data closely and stays ready to act. Any resurgence in inflation would likely trigger tightening that could stall price growth or even turn it negative in over-leveraged outer suburbs where people stretch themselves thin to get in. But here's the flip side. If inflation eases and we get a rate cut, the market could boom again as borrowing capacity suddenly improves. $55,000. That's how much a 1% drop in rates can increase borrowing capacity for an average wage earner. And that's enough to reignite serious competition for properties and send prices climbing again like nothing ever changed. $305,000 to buy a median Sydney house without falling into mortgage stress. That's real, that's verified, and that represents a permanent shift in Sydney's future that isn't reversing anytime soon. Sydney has transitioned into a global tier market where home ownership belongs to the elite and those with existing equity rather than average earners chasing a dream. And this isn't a temporary blip or a market correction coming to save the day. Decades of underbuilding, a planning system that prioritizes conservation over growth, and a monetary environment that punished new entrants while rewarding existing asset holders created this reality brick by brick. 11% of homes on the market, that's all the median household in New South Wales can afford. 97% of available properties sit beyond reach for people in the 30th income percentile, and over 100,000 residents left Sydney in a single year because the math simply didn't work anymore and staying meant financial ruin. Fragmentation will continue through 2026, with high-end inner-ring suburbs staying strong because wealthy buyers aren't constrained by borrowing capacity, while first home buyers cluster in Western Sydney corridors or settle for units and leverage government guarantees to bypass the deposit hurdle. 100,000 residents fleeing the city annually aren't giving up on home ownership. They're just accepting that it won't happen in Sydney and choosing to build their lives somewhere the dream still exists. Sydney's status as Australia's most unaffordable city appears locked in for the foreseeable future without a major shift in housing density and a massive increase in supply. And the question isn't whether Sydney will stay expensive. The real question is whether anyone will be left who can afford to live there except the wealthy, recent immigrants, and those who bought in decades ago when prices made sense. That's the reality of the $305,000 salary trap. And for most Australians watching from the outside, the door to Sydney home ownership has already closed and locked behind the lucky few who made it through.